Welcome to this brief overview of Danish covered bond legislation. My name is Morten Beckmann Nielsen and I am Head of Asset Liability Management and Investor Relations at Nykredit in Copenhagen. The legal basis of issuing covered bonds in Denmark is the Mortgage Credit and Covered Bond Act, which was last amended in 2021 in connection with the implementation of the Covered Bond Directive. The Danish covered bond legislation allows all types of real estate to be included in the cover pools. Ships are also allowed, but only in separate cover pools, and currently only one specialized lender issues covered bonds based on ship collateral. Public sector assets are eligible under the Danish covered bond legislation, but rarely used, as most lending to the public sector is either handled via municipal finance agency or the central government. Financing of public housing is carried out by the mortgage banks and carries a government guarantee, but the covered bonds issued to fund these loans are all acquired by the Danish government's Debt Management Office and therefore does not enter the covered bond market. Both residential and commercial real estate is funded via the same cover pools without any restrictions on the relative distribution of the different property types in the pool. This approach has been chosen in order to facilitate large bond series, which in turn supports strong liquidity in the covered bond market. Danish mortgage legislation allows covered bond funding of loans in all of the EU, the EEA and in OECD countries. However, prior to commencing lending in a new jurisdiction, the Danish FSA must approve the legal framework in order to secure that issuers have broadly the same security rights over the mortgage properties as if the lending took place in Denmark. In practice, loans granted outside Denmark are quite limited and almost exclusively located in Scandinavia and other neighboring countries. The maximum loan-to-value limits in the Danish covered bond legislations are set at the levels stated in the EU Covered Bond Directive. That means a maximum of 60% for commercial real estate and 80% for residential real estate. Maximum loan amounts are set based on market value of the property in question, and the Danish FSA has issued comprehensive and detailed guidelines on exactly how market values should be determined for various property types. The general rule is that market value is deemed to be the price that two independent parties would transact at within a 6-month time horizon. The issuers are obliged to monitor current LTV ratios on an ongoing basis. If current indexed LTV of a mortgage is in excess of the maximum LTV, the issuer is required by law to add additional eligible collateral to the cover pool in the amount of the difference between the maximum LTV and the current LTV. Prior to the implementation of the Covered Bond Directive, Danish mortgage banks was obliged to keep an over-collateralization in the cover pools equal to 8% of risk-weighted assets in the pool. With the implementation of the Covered Bond Directive, Denmark introduced a minimum nominal OC of at least 2%. The original requirement of 8% of risk-weighted assets still applied, giving a risk-sensitive OC requirement. The binding requirement will therefore be the higher of 2% nominal or 8% of risk-weighted assets. As all mortgage loans are used as collateral for covered bonds due to the match funding principle applied by the banks, over-collateralization will typically be in the form of government or covered bonds or deposit with eligible credit institutions on central banks. Market risk in Danish cover pools is very limited, as issuers apply the so-called balance principles, where loans are match funded by the issued covered bonds. The legislation does allow issuers to hedge market risk on a portfolio basis, and in this case, issuers must perform stress tests and comply with maximum limits for market risk. This approach, however, is not widely used. The match funding of the mortgage loans also mitigate any liquidity risk. Quarterly or monthly mortgage payments from the borrowers are always scheduled to fall due prior to the date where the issuers have to make payments on the issued covered bonds, funding these loans. For loans that need to have the funding refinanced during the loan term, it is the borrowers that bear the risk of higher funding spreads, as the borrower's interest rate is set at the current yield to maturity of the covered bonds issued to fund his loans, plus a margin for the mortgage bank. And last but not least, Denmark introduced legislation in 2014 that made soft bullet structures mandatory for covered bonds with a maturity shorter than the underlying loan contract. In line with the Covered Bond Directive, Danish covered bond issuers are required to hold a liquidity reserve for the net outflow over the next 180 days. However, the mandatory use of soft bullet structures for bonds that do not fund loans until final maturity, and the fact that quite a large part of the loan portfolio is actually funded to maturity, means that Danish mortgage banks in practice rarely will be required to hold a liquidity reserve for 180 days. But the issuers are still obliged to comply with the liquidity requirements under the LCR and the NSFR. The soft bullet requirement is primarily implemented to cope with the emergency situation where a mortgage bank is unable to roll over funding. If this should ever happen, the bank will in the end be forced to make use of the soft bullet feature. The bonds will be extended by 1 year, and the coupon of the bonds will step up by 500 basis points in order to compensate investors. For floating rate covered bonds with maturity below 2 years, there is a second automatic trigger built into the bonds in case interest rates increase by more than 500 basis points. In this case, the bonds will be extended for 1 year and the coupon will be capped at 500 basis points above the previous rate. Danish legislation had never required issuers to appoint a cover pool monitor. Instead, the monitoring of the assets and the compliance with the regulation is delegated to the issuer's internal as well as its external auditors and checked by the Danish Financial Supervisory Authority. This approach springs from the fact that all but one of the issuers in Denmark are specialist banks with no other activities than mortgage lending funded by issuance of covered bonds. The introduction of a cover pool monitor was therefore not deemed to be relevant in a Danish context. The transposition of the Covered Bond Directive into Danish law did not require any major amendments to the existing mortgage credit and covered bond legislation, as it was already aligned with the directive to a very large degree. Even secondary legislation only required minor amendments. The directive did therefore not change the Danish covered bonds compliance with the CRD's Article 129, and the eligible collateral for Danish covered bonds remains unchanged. As mentioned previously, almost all covered bonds issued in Denmark are funding mortgage lending backed by residential and commercial real estate. The Danish legal framework allows issuance of both European covered bonds premium and regular covered bonds. The vast majority of both outstanding stock and the new issuance is taking place in the premium format, which secures a preferential regulatory treatment for eligible credit institutions and institutional investors. With the updated legislation, the Danish covered bonds maintain their position as a cornerstone in the Danish financial system, just as they have done since the adoption of the first Danish covered bond law in 1851. Thank you for your interest.